India presented its landmark 2023 budget with its annual economic survey. Let's first talk about the state of economics in India. As per the economic survey, pandemic phase seems to be over and recovery is complete. IMF has predicted India's GDP to be 6.8% in FY 2023, with a slight dip in 2024 to be around 6.1%. And GDP again is predicted to come back to 6.8% in FY 2025. India continues its momentum despite a global slowdown. Robust domestic conditions in 2022 have provided stimulus to the industrial demand. Industrial growth ensures that domestic production can accommodate domestic demand and reduce the reliance on imports. Secondly, industrial growth has multiplier effects, which translates into employment growth. Thirdly, industrial growth spurs growth in services sectors such as banking, insurance, and logistics. India's service sector witnessed a swift rebound in FY 2022, driven by growth in contact-intensive service subsector, which bore the maximum burden of pandemic. This subsector completely recovered from pre-pandemic level in Q2 of FY 2023, driven by release of pent-up demand, ease of mobility restriction, and near universal vaccination coverage. The periodic labor force survey shows that the urban unemployment rate has declined. The average monthly gross GST collections has increased from rupees 0.90 lakh crores in FY18 to rupees 1.49 lakh crores in FY 2023, which shows higher tax buoyancy and trust-based governance. The FDI inflows have led to improvement of balance of payments for India. During April to September 2022, gross FDI inflows were $39.3 billion as compared to $42.5 billion a year ago. Computer software and hardware attracted the highest share of FDI equity inflows, that is 23.4%, followed by services, that is 15.4%, and trading, that is 12.2%. In terms of FDI inflow, Singapore was the top investing country with 37% share, followed by Mauritius 12.1%, then UAE 11%, and then US at 10%. In these times of global challenges, the G20 presidency gives India an opportunity to strengthen its role in world economic order. The budget adopts the following 7 priorities. First being inclusive development, secondly reaching the last mile, thirdly infrastructure and investment, at the 4th number is unleashing the potential, at 5th it's green growth, at 6th is youth power, and at last, that is 7th, is financial sector. The budget also focuses on reviving airports, increasing the capex expenditure to 33%, ease of doing businesses and compliances, decriminalization of economic laws, rural sector, startups, agriculture, data governance policy, and AI. The Finance Minister has announced several reforms and measures to bring down the burden of tax on the Indian citizens and Indian corporates. In indirect taxes, various custom duties have reduced and rationalized. Accordingly, it is proposed to reduce the number of basic custom duty rates on goods other than textiles and agriculture from 21 to 13. To further provide impetus to green mobility, custom duty exemption is being extended to import of capital goods and machinery required for manufacture of lithium-ion cells for batteries used in electric vehicles. It is also proposed to provide relief in custom duty on import of certain parts and inputs of mobiles, like camera lens, and continue the concessional duty on lithium-ion cells for batteries for another year. There are also changes for television, electrical kitchen chimney, denatured ethyl alcohol, marine products, lab-grown diamonds, metals, and precious metals. National calamity contingent duty on specified cigarettes is proposed to be revised upwards by about 16%. Major changes in cases of corporates are micro-enterprises with turnover up to 2 crores and certain professionals with turnover of up to 50 lakhs can avail the benefit of presumptive taxation. Now it is proposed to provide enhanced limits of 3 crores and 75 lakhs respectively to taxpayers whose cash receipts are no more than 5%. Moreover, to support MSME in timely receipt of payments, it is proposed to allow deduction of expenditure incurred on payments made to them only when the payment is actually made. For startups, it is proposed to extend the date of incorporation for income tax benefits from 31st March 2023 to 31st March 2024. It is further proposed to provide the benefits of carry forward of losses on change of shareholding of startups from 7 years of incorporation to 10 years. There are also such measures such as reducing the TDS rate from 30% to 20% on taxable portion of EPF withdrawal in non-PAN cases, not treating conversion of gold into electronic gold receipts and vice versa as capital gain, extension of period of tax benefits to fund relocating to IFSC, GIFT City till 31st March 2025, decriminalization under Section 276A of the Income Tax Act, and many other measures. Major change in case of individuals are: person in the new tax regime with income up to 7 lakhs will not have to pay any income tax. There are also changes in the slab rates from 6 to 5. It is proposed to extend the benefit of standard deduction to the new tax regime. It is also proposed to reduce the highest surcharge rate from 37% to 25% in the new tax regime for the super rich. It is proposed to increase the limit to 25 lakhs from the existing limit of 3 lakhs for tax exemption on leave encashment on retirement of non-government salaried employees. The focus is towards the knowledge-based and technology-driven economy with inclusive growth of every strata of society.